I've been in the camp suggesting that the inflation was going to be moving sideways on a multi-month average this year, once you got down into the low threes, and that's what's happening. 1 month's PPI, one way or the other, doesn't really tell you anything. More importantly, the Fed needs to talk about what its forecast is and what its goals are. But for people trying to assess inflation, yeah, we're stuck at around 3% inflation. I would expect headline CPI to go down a bit more in the next few months and then come back up a bit.
So given that backdrop, Adam, what do you think our Federal Reserve should do over the coming months here as we head into an election?
I think they should hold off on any rate cuts until at least November, barring something strange happening like a financial problem or a cratering of the real economy, which I find extremely unlikely. I think they should be prepared and laying the groundwork for raising rates in 2025. And I think they should be looking at and arguably talking about the fact that either they're going to change the inflation target and move it up, or if they don't want to do that, they need to explain why they're comfortable with inflation staying around where it is for a while. They can't just keep hoping that someday they'll get to change the target, but they don't have to talk about it now.
So, all right, Adam, so one of the key drivers, obviously, for the Federal Reserve is just the U.S. consumer here. We had some Home Depot results today that were a little bit weaker than expected. Of course, we'll hear from Walmart tomorrow, Thursday, after the Thursday with their earnings. How do you view the U.S. consumer here?
I mean, the U.S. consumer is continuing to be quite strong. The idea that it's tapering off some versus a year ago is not a surprise, given that real income growth hasn't been that high and that people are saving less now. So we're coming to a point at which U.S. households are probably on average not going to keep decreasing their savings rate. And so fine, but the Fed isn't supposed to be trying to fine-tune the economy, to use an old phrase Tom will recognize. And so a little bit of slowdown in consumption is okay.
You know, I look at Posen at the real yield here, and I think we need to frame it within nominal GDP. The great miscall of the last 24 months, maybe post-stimulus, and Blanchard wrote about this brilliantly, calling the third stimulus the Biden stimulus. We've all misjudged real GDP, and certainly we've all misjudged nominal GDP with this sustained inflation that we've had. Do you have in your head where the real yield needs to migrate to assist business, to assist a beleaguered housing market? Where does the real yield need to head?
I think the real yield needs to head where it has to head, irrespective of business in the housing market, Tom, and that is flat to up. I think our star, the neutral interest rate, is going up because we've got productivity rising, we've got risk aversion down, we've got division in the world with China, so less capital inflowing here. We've got growth prospects up, we've got fiscal discipline down.
Okay. I got to rip up the script here because we just got time. This is so important because we just had Vice Chairman Clarida in here as well, and he agrees with Adam Posen that there's a new R-start. How do you presume the messaging of the Fed teaches us that 2% is history?
So the way they're doing it for now is Powell and a couple others are starting to sort of float the idea that maybe our star is up, and for good and bad reasons, mostly good, they claim. And they start redoing the dots every couple months, every few months, and moving up bit by bit that 10-year projection, 10-year rate projection. But I think it would be helpful for them to talk more bluntly about why our star might be up, and if our star is up, how far that would be. And then additionally, they then have to confront the fact that if our star is up, then their policy isn't as tight as they think it is.